Rahul Jain, the Vice President of Research from Dolat Capital, is also joining us on the show right now. Rahul, hi, good to be speaking with you. To begin with, how would you rate Zomato's performance? We were calling it a business as usual status quo with no major fireworks. Would you concur?
Yeah, sure. So I think as far as the reported earnings are concerned, they are pretty much in line. The profit number could have been slightly better, so that is a small disappointment. But I think the more action right now is around what's going to shape up from here on, because a lot has changed in the last couple of months. We have seen the competitive intensity picking up meaningfully, and there is a step announced from their perspective as well, where they want to raise capital because they acknowledge the risk that they see ahead of it. So I think from a reported performance perspective, we could see some of these impact or reactions in the coming quarter, while this quarter was business as usual, as you guys highlighted.
But Rahul, whenever they will raise capital, a quarter, 3 months, 3 weeks, we don't know. But ultimately, we are looking at a huge supply of 8,500 crore coming in. And then periodically, P guys are selling. So do you think Zomato, more than anything else, now the stock could suffer because of this extended supply pipeline?
Yes, supply historically we have seen in this company has been pretty conveniently absorbed ever since they have shown that path of profitability a couple of quarters ago. So I don't see that as a concern, but of course for any investor who would see that the current earnings would be closer to 1 rupee EPS on a 12-month forward basis, the valuations are stretched. On top of it, if there's a dilution, there is a clear thought process that some of this dilution is happening because of the need for the investment in the business. So if the current valuation are high and there is no sight of meaningful EBITDA expansion, rather seeing increased competition, so there could be in general a period of time correction or absolute correction that could happen in the stock.
Right. Rahul, I'm going to take the liberty and, ask you on Paytm as well. Can't not. And after months of that freeze from the RBI on UPI, they finally have got the go-ahead to onboard new UPI users. Big fillip, you think?
Yeah, of course. From a business perspective, new UPI account onboarding is very, very crucial because they have seen slippage of almost 30% from the peak MTUs that they were having. So getting the power to win back some of the existing as well as now a new customer with this NPCI approval would definitely enhance the MTU profile, which is required to ensure a sustained high growth. Other than the business factor, I think this is also a big clearance of the overhang since there is so many regulatory tussle that they have faced in the past. Then the announcement on the payment aggregator clearance and this NPCI clearance is definitely a very, very positive thing for them to happen, and this would boost both growth as well as the perception about the business.
Back to where it was, let's say before the problems happened, I think the high was 700, 800 or 900. I mean, now that all problems are sorted, it should at least go back to those levels?
Yeah, I think there is a clear business improvement that we already saw in the quarter two. There was a significant growth as well as improvement in the profitability side. They have already identified Q4 to be a quarter when they become adjusted EBITDA positive. So moreover, by Q4, we will be at a number which they kind of reported before all of these challenges started coming in Q3 of last year. So it's kind of a 1 year of hiatus and they are back to where they were, X of one or two products. So yes, there is no reason why it should not go back to where it was and probably extend the rally beyond.
Okay. Rahul, the other thing that caught everyone's attention in the earnings yesterday was the default loss guarantee that they gave for one of the lending partners. What do you make of that, 225 crores?
So yeah, 225 crore is the upper limit board approval that they have taken, is the maximum risk that they can take from a DLG perspective. I think the current exposure is significantly lower number than that. And at this point, what we need to understand is that if they are taking this DLG exposure, which is like a higher risk other than the distribution business they were into, it should also come with higher take rates. If the take rate picks up, which company has acknowledged that the net take rate for them would remain same even after this new experiment, then probably there would not be any such overhang. Of course, the risk of capital can always be there in the future whenever the credit cycle is very bad, and there could be some set of people who may not like it. But for me, I think we would continue to watch out the take rate and see if these are adequately compensated for the additional risk required.
Right, Rahul, so glad you could take time out this morning and speak with us. Thank you so much.
Thank you.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.